A potential bumper crop of corn actually has corn growers a little bit worried this year. I'm Katrina Markle in Saunders County, where Dan Wesley, a veteran farmer, told me that his industry needs to find more markets for their product.
Help me understand why more corn equals less money, potentially.
Just more supply, and we need the demand, and that's what we've been lacking the last few years, new trade agreements or new places to go with our product.
Basically, Midwestern farmers are producing more corn than we can use in the United States, so they have to export it or find new markets like year-round E15 ethanol.
This weekend, Joe Vaclavic and Mike North joining us to talk markets. All right, Joe, I'll start with you because we did see grain prices pressured this week. Why?
Two things. Let's start with corn. I think we've got a supply problem in the United States. The crop's going to be really big, probably a record, probably not as big as USDA would have indicated last month, but still very big. The farmer is undersold. There are a lot of new crop bushels. The vast majority of this year's corn crop has not been priced, hedged, sold. And I think the market's aware that that's selling.
Imagine waking up to see billions of dollars disappear overnight, because that is exactly what just happened to American farmers. For years, the United States depended on Africa as one of its biggest buyers of corn. Billions of dollars flowed in, American farmers expanded their fields, and Washington believed the market was secure. But Africa made a decision that no one in America expected. Africa reduced its corn imports from the U.S. and instantly, $3.1 billion in revenue vanished. American farmers who were already struggling with debt, rising fuel costs, and unpredictable weather suddenly found themselves with overflowing storage, crashing prices, and no new buyers. Some say this is the biggest agricultural shock America has faced in a decade. Meanwhile, Africa is now turning to new partners: Brazil, China, Argentina, and even its own local producers. And for the first time, the U.S. is no longer the number one choice. Washington is frustrated, farmers are angry, and Africa's message is simple. We are choosing what benefits us, not what benefits America. Today, we break down how this $3.1 billion loss happened and what it means for the future of Africa-U.S. food trade. When the news first broke, many people thought it was a mistake, a typo, a miscalculation. Because how could a single decision by African nations wipe out more than $3.1 billion from America's agricultural revenue in just 1 year? But as global markets began to adjust and as American farm unions started ringing the alarm, the truth became undeniable. Africa had quietly reduced its corn imports from the United States on a scale big enough to shake the U.S. farming sector from top to bottom. For decades, American corn was everywhere. It was in African food industries, in livestock feed, in food aid programs, and in long-term supply agreements. America believed the relationship was ironclad. American farmers invested heavily in equipment, they expanded farms, they built storage silos, they took loans assuming demand from Africa would always be there. They believed the African market was secure, stable, predictable, but times have changed. Africa has changed, and the world around Africa has changed even faster. The first signals were subtle. African ministers started visiting Brazil more frequently. Trade delegations began appearing in China, Argentina, and even Russia. With every handshake, with every press release, with every new partnership, a clear message was being delivered: Africa was no longer comfortable relying on the United States for essential food imports. America ignored the warning signs, but Africa didn't. Then came the shift, not sudden, not dramatic, just gradual enough that many people didn't see it coming. Africa quietly reduced orders from U.S. suppliers. Shipments dropped, contracts were not renewed, and when the numbers were finally reviewed at the end of the year, the economic truth hit like a hammer. More than $3.1 billion of American corn sales had simply disappeared. Not due to drought, not due to war, not due to supply shortages, but due to a strategic choice made by African countries. The reaction across the United States was immediate. In states like Iowa, Nebraska, Kansas, and Illinois, farmers who had already been struggling with rising costs suddenly faced a devastating surplus. Millions of tons of corn had no destination. Prices fell, storage costs rose, fuel costs rose. Many farmers found themselves holding products with nowhere to send them. Some had taken loans expecting steady export revenue. Now those payments became nearly impossible. Complaints flooded agricultural hotlines. Farmer associations pressured Washington for answers. Yet the only answer Washington could offer was the one nobody wanted to hear. Africa made a sovereign decision. To understand how this happened, we must first understand what Africa saw. Africa has been accused for decades of depending too much on American food, and for a long time this dependence was by design. American corn was affordable, reliable, and backed by powerful U.S. subsidies. It was easy for African governments to buy American corn instead of investing in local farmers. But this came with a hidden cost. Local African farmers struggled to compete. African agriculture remained underdeveloped, and America gained massive leverage over African food markets. But the global order has shifted. Africa is rising, industrializing, modernizing, and forming new alliances. Nations like Nigeria, Kenya, Egypt, Ethiopia, Angola, South Africa, Tanzania, Rwanda, Zambia, Ghana, and Algeria are actively working to reduce foreign dependence, especially dependence on American food supplies. And so when global prices fluctuated and when African leaders saw more competitive offers from Brazil, Argentina, and China, the decision came naturally: why buy expensive American corn when other suppliers offer better deals, better financing, and even agriculture technology investments? Brazil was the first to take advantage. With massive farming capacity and lower production costs, Brazil began offering Africa high-quality corn at cheaper prices and with long-term delivery guarantees. China followed by increasing its presence in African ports, shipping corridors, and grain terminals. Argentina, recovering from its own economic challenges, saw Africa as a major opportunity. Even Russia began offering grain deals to African nations despite geopolitical tensions. Africa was suddenly in a position it had not experienced before: choice. Real choice, multiple suppliers competing for its market, and with choice came bargaining power. African leaders were no longer forced to accept American terms. They could negotiate, compare prices, compare logistics, compare political relationships, and in that process, America, confident, unbothered, and slow to adapt, lost the competition. While Africa diversified, American farmers watched their export numbers collapse. Many couldn't believe it. They had been told for years that the African market was secure, that Africa needed America, but Africa had outgrown that narrative. Inside the United States, frustration grew. Some farmers blamed the government for not maintaining strong trade relationships. Others blamed rising production costs, saying U.S. corn had become too expensive to remain competitive. Others blamed politics, pointing out that America had spent years lecturing African nations while other countries came offering partnerships, respect, and better deals. But deep down, what truly hurt American farmers was not just the financial loss. It was the realization that the world no longer revolved around them. Meanwhile, in Africa, the shift was being celebrated as a moment of economic independence. Governments proudly announced new agricultural investments. Countries like Kenya, Ethiopia, Tanzania, and Zambia amplified their own corn production. African farmers were suddenly earning more because local industries were now buying local grain instead of imported American products. The circulation of wealth stayed within the continent. African analysts pointed out that depending too heavily on American imports had made Africa vulnerable to price shocks and geopolitical pressure. By reducing reliance on the United States and increasing partnerships with diverse suppliers, Africa was protecting itself from economic risk. African countries also began investing in irrigation, crop research, and large-scale farming technology. These investments, many supported by China and Brazil, made Africa more competitive and more independent. But as Africa rose, the political pressure inside the United States intensified. Senators from agricultural states demanded emergency support for farmers. Some called for America to regain influence in Africa. Others demanded the government negotiate new trade deals. But the truth was painful. Africa was no longer waiting for America. Africa had moved on. Because while American politicians debated, African countries made deals. Brazil offered long-term contracts. China offered infrastructure in exchange for grain partnerships. Argentina offered competitive prices, and Africa responded. These new partners didn't criticize African leadership. They didn't lecture African governments. They didn't interfere in internal politics. They simply provided business. American analysts realized too late that U.S. foreign policy had created its own problem. While Washington spent years focusing on military strategy and geopolitical influence, it neglected the economic relationships that actually mattered to African nations. The United States assumed Africa would always remain a buyer, but Africa became a competitor. The $3.1 billion loss may look like a financial number, but behind that number are real American farmers facing bankruptcy, real families losing land, real children watching multi-generational farms collapse. Many of these farmers believed they had the protection of the U.S. government. They expected policymakers to ensure stable markets. They expected America to maintain good relationships with African nations. But global trade does not reward entitlement. It rewards competitiveness. As American farmers demand help, Africa continues to strengthen its agricultural independence. Countries like Nigeria are increasing maize production through modern irrigation. Ethiopia is expanding its farmland capacity. Zambia aims to become a food export hub for southern Africa. South Africa continues to grow some of the continent's highest quality maize, and new intra-African trade agreements are connecting regional markets faster than ever before. Africa is no longer a passive importer. It is becoming a producer, a competitor, and a distributor. This does not mean Africa will completely stop importing American corn, but it does mean the era of automatic American dominance is over. Africa will buy corn from whoever gives the best price, best quality, and best partnership terms. And if America can't offer that, then America will continue losing billions. The $3.1 billion loss is not an African victory or an American defeat. It is a sign of a new world order, one where Africa's decisions matter. One where African leaders are not afraid to choose what benefits their nations. One where American farmers must now compete like everyone else. And one where economic power is shifting southward and eastward. In the streets of Iowa, some American farmers feel abandoned. In the farmlands of Kenya and Zambia, African farmers feel empowered. And in boardrooms across Brazil and China, exporters feel triumphant. This is the new global agricultural map, and the United States must either adapt or keep losing. Africa's decision is not just about corn, it is about dignity, it is about control, it is about ending decades of dependency and stepping into a future where Africa sets its own terms. For some, this change feels threatening. For others, it feels overdue. But for Africa, it feels necessary. And so, as the global economy adjusts, one lesson becomes clear. In the modern world, trade flows to where it finds respect, reliability, and opportunity. Africa no longer sees the United States as its only option. And for the first time in modern history, the United States must accept that Africa has choices, real choices. The $3.1 billion that America lost is more than a statistic, it is a message. A message that the future of agriculture, trade, and global power will no longer be dictated by old alliances or old assumptions. Africa is stepping forward. Africa is buying smarter. Africa is negotiating harder. And Africa is showing the world that it is no longer just a market. Africa is now a player. The real question now is not why America lost $3.1 billion. The real question is, how much more will America lose if it refuses to respect Africa's rise? As we close this story, one thing is clear. The world is changing faster than anyone expected. For decades, American farmers believed the global market would always rotate around them. They believed their crops would always find buyers, their prices would always stay high, and their government would always protect their interests. But the $3.1 billion loss triggered by Africa's decision has proven something powerful. No country can take another country's loyalty for granted anymore. Africa's move wasn't an attack, it wasn't revenge, and it wasn't political punishment. It was simply a continent choosing what benefits its people first, not what benefits another nation. For years, Africans were told they had no choice but to rely on American corn. They were told it was the only option, the most reliable option, the safest option. But today, Africa has options, real options, options that offer better prices, better respect, and better long-term partnerships. And when Africa finally chose what was best for Africa, the entire world felt the shift. American farmers are now waking up to a painful reality. Global trade is not built on loyalty. It is built on competitiveness. And in the modern world, the United States is no longer the only giant in the room. Brazil is rising. China is investing. Argentina is expanding. Russia is re-entering markets, and Africa itself is producing more food than ever before. The world is becoming multipolar, and America must now compete, not command. But in this new reality, the biggest question is not what Africa did, but what America will do next. Because the truth is, losing $3.1 billion is only the beginning. If the United States continues with the same approach, lecturing instead of listening, pressuring instead of partnering, this loss will repeat itself in wheat, in soybeans, in poultry, in everything. The world is rewarding respect, it is rewarding equal partnerships, and for years African leaders have complained that the United States only comes with conditions, not cooperation. Now Africa is choosing partners who come with investment rather than interference, and the results are becoming visible in every sector. On the other side of the story, something incredible is happening in Africa itself. Young farmers are rising, local industries are expanding, governments are investing in irrigation, fertilizer plants, and modern machinery. Africa isn't just buying food, Africa is preparing to feed itself and eventually to export food to the rest of the world. For the first time, African farmers are earning more because African markets are buying African products. This is not just an economic change, it is an emotional one, a psychological one. A moment of dignity for millions who have watched their continent depend on others for too long. As we end this documentary, remember one thing. This story is bigger than corn. It is bigger than America's loss. It is bigger than trade statistics. This story is about a shift in global power. A shift in how Africa sees itself. A shift in how Africa chooses its partners. A shift in how the world must now treat Africa not as a silent customer, but as a strategic player. Millions of American farmers tonight are wondering how they will survive this loss. Millions of Africans tonight are wondering how much more their continent can rise if it continues choosing what benefits its people. In a way, the $3.1 billion was not just a financial shock, it was a wake-up call to the entire world. Because the message is undeniable. Africa is no longer waiting for permission. Africa is no longer accepting old rules. Africa is making its own decisions, and the world must now adjust. And as this new era unfolds, one thing is certain. The more Africa stands strong, the more global powers will be forced to treat Africa with the respect it has always deserved. Thank you for watching. If you found this eye-opening, make sure to like, share, and subscribe so more people can understand how the world is changing and why Africa's rise can no longer be ignored. Africa has spoken, and the world is finally listening.